We are going to start today's session with a conversation with Ben Narasin, founder and general partner of Tenacity Venture Capital. Ben, welcome to the show.
Thank you for having me.
So let's start by having you introduce yourself a little bit to our audience, both to your personal background as well as the genesis of Tenacity. I know you have a new fund that you want to introduce.
Yeah, thank you. So my background is a mix of, I spent 25 years as an entrepreneur. That culminated in starting one of the first e-commerce companies in 1993, when people didn't really know what the web was, they didn't even know what the internet was. And then in 99, I was able to take that company public, a company which I basically bootstrapped. So since I did not raise any venture capital and I bootstrapped it, I still had control of that business when the bubble burst. And I was able to take it private, which allowed all the shareholders to participate equally and fairly in the relatively significant amount of capital we'd accumulated at the time. That was in New York City. I left there, moved west, ended up in California about 18 years ago, in Silicon Valley specifically, and became very enamored of the entrepreneurial community here and became a seed investor in 2007. I was recruited in to build and run the equity practice of a large venture debt shop. And in 2007, I believe there were three of us, three different organizations. I think Josh Kaufman had started First Round Capital about a week before I came on the scene, and I think Jeff Clavier was active in the business. I think that was it. Those were the three institutional seed funds. Now, since then, seed has grown quite a bit. So I spent about 8 years as a seed investor, and then I had two $5 billion outcomes in a year, and a lot of my friends I'd gotten to know in venture started talking to me about crossing over to become a traditional VC. So I spent the last 6 years as a traditional VC, most recently at NEA, New Enterprise Associates, one of the largest and oldest venture firms in the world, a really phenomenal group of people. And I just recently, actually only about a month ago, spun out to raise a new freestanding seed fund called Tenacity Venture Capital. So now it's a blend of my 25 years as an entrepreneur and my 14 years as an investor. I'm now a entrepreneurial investor, a founding venture capitalist. So I'm out raising money just like all the entrepreneurs I've ever talked to. It's gone well. I'll tell you some of the specifics if you'd like about the fund, but while I was told it would take about a year, which was fully what I expected, I was able to raise the first half of the fund in 25 days. So I think having a 14-year track record with a lot of high-performing funds has made it a lot easier versus just having a theory of things that I might want to invest in. And I'm all about, the founder, the opportunity. I always say I need 5 things to make an investment. People, a great idea, and a huge market if it works. I want to fund phenomenal founders who already have ideas I love and who have the opportunity to build truly unbounded and enormous upside businesses. So that's a capsule.
So what size fund are you building with Tenacity?
Yeah, it'll be a $50 to $60 million fund. Because I'm a sole GP, so in essence, it'll be a one-man band. And I look at my history and I look at about 1,400 to 2,000 pitches a year, but I only fund about 7 to 10 when I'm doing seed. And since this fund will be leading and co-leading, I assume it'll be 7. So basically the way I figured out what size fund would be appropriate is I looked at my pace, which I don't want to change because I think when people try to change their pace, they lower their bar and that results in less compelling returns. So if I do 7 deals a year, according to PitchBook, the average seed deal was $2.6 million in the first quarter of this year. So that's an overly simplistic rubric. I said 7 times 2.6 times the 3 years it'll take to deploy gets me to about 55 million, hence the 50 to 60 million range. Right now, if things continue at the pace they have, it looks like I'll have more capital available to me than I'm asking for. But it is important to me to maintain the rigor of keeping it in that size because, as I mentioned, I think that when people raise more money than they plan, it changes their behavior, and I don't think it changes it in a positive way. So I want to keep it tight.
Yeah, well, I think in the 90s, the venture funds that worked in the early stages used to be about 250, 300 million. And then they started changing size and started becoming billion to billion funds. And they lost the capacity to do earlier stage investments in many ways.
Yeah, you're absolutely right. In
So,
fact, this was part of the phenomenon I saw, in 2007 was that there was this gap in the market because you had a variety of angel groups and angel investors, and they were very small checks and very slow processes. And then on the flip side, all these venture funds that used to be a few $100 million had turned into multi-billion dollar funds. And so they had to write bigger and bigger checks because it's very hard to scale venture capital. I'm not sure you even can. It's a people business. It's still a cottage industry. There's lots of reasons. I'm happy to talk about it if you'd like. But what happened was when you had the small and slow over here with the angels, and you had the bigger checks in the venture, in the middle was what is now called seed. But there was nobody doing it, and so that's why it seemed like such a great opportunity. Just creating a model where, on the back of the fact that the web had empowered people to start businesses so quickly and so inexpensively, they needed a source of capital that could match that relative ease and speed compared to the prior era. And it's obviously been a successful category and grown quite a bit since the three of us were out there.
yeah, in fact, today the industry is kind of fragmented or segmented, I would say, in the seed and the capital industry into pre-seed, seed, post-seed, pre-series A, post, like early series A, like a small series A, and then
Yeah, baby
traditional venture
A's and
capital.
mango seeds.
So yeah, where are you positioning? Are
Yeah,
you
I'm
doing
I'm happy
pre-seed
with
or
anything before the Series A. Incubation,
any?
formation, pre-seed, seed, second seed. Very pretty rare on
Okay.
the second seed, to be honest. But um, it's just my focus has always been finding entrepreneurs that I believe to be venture scalable and helping them raise their first venture round. And I've had a very high conversion rate, so it appears that's worked. I got to know over 327 VCs in my 8 years as a seed investor. And in that 8 year period, between 63 and 71% of the companies I seeded went on to raise follow on rounds, typically Series A's from tier one firms. And those rounds often came either from introductions I made or I was involved in, I funded 80 companies in 8 years, and I believe I was involved in every single Series A. Now, that doesn't mean the entrepreneurs always took money from the people I introduced them to, but I always introduced them to, one of the things about the venture debt industry is they tend to be very well aligned with the top tier firms. And so, my 327 person network was entirely derived from sort of the top 15 firms. So, a lot of my work was figuring out who to take entrepreneurs to that would be right for their business and their personality. And so, I like to get there early enough to be helpful, sometimes to be even a little bit formative to the business and the entrepreneur's development, and then to help them pick the right partner and to help them with that fundraise. So, anything before the A is fine. I've even sometimes been brought in on the A. I had an entrepreneur, great founder out of LA, and I had seen her in a startup competition and we talked a lot, but there was a risk I couldn't get comfortable with, so I decided to wait. And she came back to me 6 months later for some advice and talked about how she was doing, and she was doing exceptionally. And I was like, I think I probably should have invested. Can I invest now? She said, well, it's too late, it's 6 months later, but if you can help me raise my Series A, then you could invest alongside. So I introduced her to the fund that became her Series A investor and participated in the round. So, a big part of my thesis and value add, and the thing a lot of my entrepreneurs will say, is that I can really help them get a successful Series A done. If they're like, one of my little rules is I'll help you raise your Series A if I think you're ready, not if you think you're ready, because it's one of those things a lot of people want to do, but it doesn't mean they're ready for it. And, I'm very picky about who I introduce to who. And that's true for both. I want the entrepreneurs to know the right people. I want them to have the right possible board member, but I also want to make sure the VCs are seeing companies that are fundable. In making introductions to VCs over an 8 year period, and there were hundreds, I think I had two people ever say no to an introduction. Um, Interestingly, I think Mark Berry was one of them. I guess I didn't know him as well as I thought, but that was it. Two people said no to companies that got funded that they should have said yes to at least meeting. So, it's been a good track record. I'm happy, and I think my entrepreneurs are very happy.
I'm smiling because we do exactly the same thing. Very often people come to 1 Million by 1 Million looking for investors. We don't operate as a fund, but we have a network of hundreds of investors who work with us and look at our deals, and we are very particular about making sure that they are fundable before sending them to VCs by
Yeah.
our judgment, not by their judgment. And it's exactly the same logic that you just laid out that we have in how we do the investor introductions.
Yeah, it's very important because, it takes a lot. I spent an inordinate amount of time and money over that 8-year period getting to know these folks. I was very fortunate to have a
Exactly.
platform that gave me pretty much unlimited time and money to do it. But, those relationships are, I think of myself almost as, this is not a perfect analogy, but over the last 18 months, we've been fostering puppies. And we have fostered 64 puppies. My attitude is my job is to give these puppies a safe, happy home. So when they go off into the world, they are good puppies to the families that are there forever home. And so when I think about my own interactions with my entrepreneurs, like I have a lot of adopted, let's call it children for lack of a better term, and I can't bend the discipline because if I do, then that really deserving, phenomenal, let's go with puppy, doesn't get the opportunity if I sort of stretch a bit to get someone that's not ready to go out there to go out there.
Yeah.
And so, you want to protect those relationships. Those relationships, this is a very, life is long normally. And you want to make sure that both sides, it's one of the peculiarities of the venture business, by the way. I remember I was talking to a VC once. We were on a board together or invested in the same company, and they were raising like a Series B or a Series C, and I was making all the introductions. And I said to the VC, like, why am I doing it? I'm a seed investor. You're their VC. Like, shouldn't you be making these connections? And they said, Ben, I don't usually make connections for my entrepreneurs. If I connect an entrepreneur to another VC, it makes them look weak. Now, I'm not going to say everybody feels that way, but I have found it's relatively common.
It's a very odd logic. I don't agree with that at all.
I think that a lot of VCs feel like if it had to be introduced, it wasn't strong enough to get there on its own. But when you've got a seed investor, it's the opposite. The seed investor is expected to make those introductions, and every venture firm, and I've worked in a couple, they always have a list of the seed investors that they want to stay on top of and that they respect. And so as long as that respect is maintained and that trust, they're going to listen to what is said. So when I help entrepreneurs raise, the number one thing that'll happen is, I make an introduction, they go in to have a pitch, and if the VC likes it, I get a call, and it's like, tell me about Bob, tell me about Jane. They want to know what my year with that entrepreneur has taught me. And, they all have, basically, when they say, tell me about Bob or tell me about Jane, what they're really asking is this, and sometimes they just ask it this way, is this the long-term CEO? Is this the entrepreneur that can take it all the way from the exciting growth they have today to a future public company? And, and by the way, if they're not, is it going to be a problem? So, by then I'll be able to say, I don't know if they can scale all the way to IPO, but I'm positively inclined to believe so, because usually those are the type of people I'm taking out. And I think they're so dedicated to this business that if they were not the right person, they would probably see the logic of perhaps becoming the, if they're highly technical, maybe they become the CTO and bring in a professional CEO or whatever it is. But, it is interesting to me that when I was a VC, all the people I know tend to call me when I introduce them to entrepreneurs if they're interested. They're either asking about the entrepreneur or they're asking how to win in a highly competitive round because they want some back channel. They want to understand like what they need to do, what they need to offer to get this round to come together. But having been on the inside of multiple venture firms, it is very rare for VCs to reach out to the earlier investors, which I find confusing because as long as there's a trusted relationship, they're a great source of intel. I mean, what better way to know a little bit about an entrepreneur than to talk to the person that spent the last year with them and watched how they developed? So it's a funky world. It's a small world.
It's a very funky world.
Yeah.
It's a very funky world. I've been in Silicon Valley since 1996, actually. And it has changed a lot, but yes, it is a very funky world. So let me ask you, one of the points that we stress in 1 million by 1 million is just like you're looking for product market fit, you also need to look for investor entrepreneur fit to make a deal happen.
Yeah, absolutely.
So what is your investment thesis? People, great market, all of that is kind of generic, but tell me a bit more about what you like to invest in, what kind of things, what problems in the world that you have your eye on perhaps, and what segments do you particularly like? We talked about you starting off as an e-commerce entrepreneur. Is e-commerce still an interest, or is that a played out sector for you?
It's funny. I remember once I met I made a very proactive effort to meet every VC at the top 15 firms. I mean, I tried to cover 100% of them. And there was let's just say an investor had just joined one of the best firms in the world. And I took him out to lunch. And he told me a story of what he had done. He had basically created let's go with mobile advertising platform, which sold for maybe a little shy of $1 billion. And he still owned most of it. So he did exceptionally well. And I said, oh, that's great. I have two really great mobile ad companies you should meet. Um, and he was like, Penn, you got to have a lot of naivete to invest in mobile advertising. And I was like, oh, interesting, since you made, $500 million personally doing that. But the reality is, I would argue everybody that's ever done something thinks anybody else that does it must be naive and they are, because they know how hard it is, right? You have firsthand experience of how excruciatingly difficult it was to do that thing. So there's no illusions about it. Now, interestingly, of those two companies, one sold for about $1 billion and I made 60 times my money. And I think the other one didn't work out. So, it worked out for me on a blended basis. The reality is I've looked at e-commerce. I just haven't found it. I probably have a higher bar there because of my experience. Just like there's some other categories. I am a generalist. I believe the best entrepreneurs are highly focused, but I believe the best investors are generalists. Think about it. Sequoia and Benchmark, which are the two best firms in the world, return-wise, are both generalists, and every investor there is a generalist. Scott Sindell, who runs NEA, he's a generalist, one of the best investors in the world, certainly of our generation. The best investors are generalists. I am more focused on...
I'll push back on that. Hang on 1 second. There's a company that I have great respect for, that is Emergence Capital. That is not a generalist firm at all. They started with in fact, I did their story just like you were talking about your starting Tenacity. And at this point, it's a similar point. I had talked to Brian Jacobs, and he presented a thesis of investing in SaaS at a time when nobody was doing SaaS, and they did phenomenally well with the whole SaaS trend.
So, I'm not saying only generalists are great investors, but the very best investors are generalists. I think Ribbit is an exceptional firm, and they do fintech. They're great fintech investors. I do a lot of fintech. But, the way I think about it is I'm hyper focused on the entrepreneur. The firm is called Tenacity for a reason. I think that brilliance is assumed, or I wouldn't have funded you. A great idea is assumed, or I wouldn't have funded you. And a huge opportunity is assumed, or I wouldn't have funded you. The only secret to your entrepreneurial success is tenacity. I spent 3 years, funded 30 companies, and had 0 fails. And this worried me a great deal because I thought I wasn't taking enough risk. And so I loosened up. That was a mistake. I had my very first fail, and it was an entrepreneur who gave up. He gave up with money left. It's like the horrible story I heard when I was young from my parents who were scuba divers of a man that was found dead in a cave doing a dive with a full tank of oxygen. Giving up is not an option. Like work-life balance, also not an option. Those are not things that work for people that want to be entrepreneurs. I mean, they can be entrepreneurs and just sort of
again, I disagree with you. They don't work in venture entrepreneurship.
Oh, yeah, sure. I mean, in fairness, I'm only calibrating for that. Look, I think that should be clear from the beginning. I'm focused on people that want to build future companies.
The feedback is my audience is not just if you say that you're not an entrepreneur, if you cannot have work-life balance, I have to push back on that because I have a very different segment as well that listen to these.
That's fair. But we're talking about like what I solve for and what I look for, and I look for venture scale entrepreneurs, and in that category. If you believe you can have work-life balance, I would like to meet the examples of the people that do, because I never have.
Actually, on the contrary, I think your venture scale entrepreneurs very often end up with 3 divorces in their lives. So yes, you're absolutely right. Work-life balance is most likely not an option.
Yeah, and it's not like I'm saying you need to ruin your life to be an entrepreneur. It's more that having lived through the realities, if you are going to pursue this type of entrepreneurship, you need to go in eyes wide open. Like my grandfather was an entrepreneur his whole life, and he had work-life balance. he had a solar business when the laws were such that he could have solar. He had a chemicals business. He used to own laundromats. He came home and he had his life and he led and he did well. But there's a huge difference between being sort of, for lack of a better term, day-to-day entrepreneur and being a future public company CEO. A hot dog stand is an entrepreneurial endeavor. When I was in college, I had a Dove bar truck.
So it's
I
also
literally,
an entrepreneurial endeavor. It's a billion-dollar bootstrap venture, and if you ask that CEO, that's also a very different story. So the reason I'm pushing back on a lot of things that you're saying is that they're a bit insulting to another category of entrepreneurs whom we have made a very strong effort to nurture, and we continue to believe that the venture way is not the only way. It is
I
your
totally
way.
agree with you. Yeah. In fact, I'd say the number one piece of
Don't
advice.
count the insults, please.
Yeah, no, the number one piece of advice I give entrepreneurs is usually, avoid venture capital, because there are a lot of businesses that can be really good, really healthy, wealth creation businesses that should not have venture capital because it creates a disalignment. Like, everything you're hearing from me is not what I believe every entrepreneur should do. It's just the
That's right.
type of
And the
entrepreneur.
most important thing is that big market opportunity. Hyper growth is not a natural state of business, it's a very rare state of business. So
Absolutely.
if every entrepreneur thinks that we have to achieve hyper growth, that is not viable. Most businesses don't have the characteristics of being able to meet that hyper growth criteria. So
Absolutely agree. I mean, that's why I look at close to 2,000 companies a year and I only fund 7. It's not the 1% of entrepreneurs that make sense for this. It's sort of 10 basis points. And I think sometimes there's a lot of unhappiness created or just wasted time when somebody that has a really good business. So venture wasn't built to fund really good businesses. It wasn't built to fund even great businesses. It was built to fund phenomenal outlier businesses.
That's right, exactly. But I think the problem that has been created in the media is that, the media has kind of positioned entrepreneurship equals venture capital. And that is what has created all this misconception and anxiety and rejection, constant rejections. I mean, if you get a lot of rejections, it's bound to discourage you, right? So if you're going out there too early or going out there without the right goods, and you're not a fundable entrepreneur, you go out there, get rejected and get rejected and get rejected, and you don't understand why you're getting rejected. That's really a recipe for disaster.
Well, that's why I'm so, I don't know, for lack of a better term, transparent about this point, because I think it's a great disservice for an entrepreneur that should not raise venture capital to spend time trying to do so. It's a waste of their time. Yeah. There's nothing wrong with a business that doubles every year and that makes you a healthy living. But, like, lions only eat meat. So don't try to feed a lion a salad or they'll eat you instead. So, like, using up your time to go out there and try to raise venture capital when you've got a nice, like you said, hyper-growth companies are rare. But that's sort of what venture seeks out. And finding that match is really important. I see a lot of people, I don't know if it's the media as much as it's just that there's this, well, in Silicon Valley, it's almost like if anybody lives here, they assume their business should raise venture capital. And that's, not the case in the vast majority of instances. And you just, you need to, there's lots of different forms of capital. And I think it's a long-term marriage. When you go out to raise money, you need to be able to find the kind of capital that matches the realities you want to build. Because if you don't, you end up in a situation where you could be in a, ultimately, if you were, let's pretend for a second that you had a business you wanted to build as a nice lifestyle business, and yet you managed to raise venture capital. Well, you sign a one-way prenup and you don't get the right to exercise it. So it tends to go poorly. I never raised venture capital. I had a business that I guess, it was hyper growth, but it wasn't at the level. Even though I got that company public, it was not a venture fundable business. And had it been venture funded, I would not have survived.
In fact, your e-commerce category right now, I think, is full of companies that are not necessarily venture fundable. They're niche e-commerce businesses. There's still lots of niche e-commerce businesses starting left, right, and center. Shopify is very easy to get a company started with. And then there are other kinds of financing available. You can, get inventory financing. You can get on deck to finance your transactions, exactly. There's Cabbage and On Deck, all these fintech firms that will give you a little bit of money to keep,
Yep, yep.
moving forward. So, I mean, I was curious to hear your analysis of e-commerce, because e-commerce is starting to get to a point where most of it is not really venture fundable at this point.
Well, it's interesting. There's within the category, there's some venture opportunities, certainly. As an example, today, 54% of all merchandise sold on Amazon is sold by marketplace sellers, not by Amazon. So, like
Yeah.
as an example, I wanted to understand that better. So I have a little side business. It's not even really a side business. It's just I bought a pallet of Amazon returns and then relisted it on Amazon and on eBay to sort of see what that was like. Now, the reality is the most compelling marketplace sellers are selling their own unique product. But that business, that 54% of volume is made up of everybody from the sort of sole operator selling a single product to multifaceted players. What has started to happen though is on top of that, now that people have figured that dynamic out, there have become a handful of venture-backed businesses which are buying those individual sellers and stitching them together in an effort to become the quote unquote Procter and Gamble of online.
Roll up.
So they're doing
Private.
they're doing a roll up. They're buying companies that are call it, maybe it's even as little as 1 to 5 million in revenue, but they're adding it all together to create a bigger quote unquote venture scale opportunity. So not only is there financing available for these smaller businesses through the people like, I believe it's Clearbank, that will loan against your advertising. If you can show that by spending $1 you can make $1.80, then they will fund that. And I actually invested in Cabbage when it first started out. They would fund sellers on eBay against their selling history. And now, so one, you have a source of capital, as you pointed out, but two, you have a source of liquidity as an exit. So you build your business up to a $5 million revenue business, which seems like a healthy lifestyle business to me. If you're making 40% gross margins, that means $2 million of that's flowing to you. And if you can keep your operational expenses low, that can be a really great living. But then later, there are people that will buy you because they want to roll you up, and they're paying nice multiples. It's very rare for businesses that small to be able to be paid, revenue multiples, but it's happening. So there's a great opportunity for an entrepreneur, with your million by million model to get to that first million in revenue as an Amazon seller. I maybe get it the next time, spend another year or two to get to 2 or 3 or 4 or 5. And by the way, there's not just one buyer, there's multiple buyers, which drives the price up. So a lot of opportunity both for cash flow and for ultimate liquidity. And, I learned this, I didn't have $1 billion outcome. I was not an entrepreneur. I was the type of entrepreneur I would want to fund, but I didn't have the opportunity of the scale that I wanted to fund. And I'm very happy. It's funny, we all have a quest to understand what life means to us. Every once in a while, I'm somewhat philosophical, and I'll have my entrepreneurs come over to my house every once in a while. My attitude is, if you need me, I'm there for you. We just have to figure out how to make the time work. And I do want to respect the time with my family, and I've always kept the weekend sacred. That was sort of my golden rule. That was as close to work-life balance as I could get. My wife and I, when we were about to have our first child, we talked about it quite a bit because I was working in a company that would go public a couple years later. And, she said, look, if you can work all-nighters 5 days a week, just give us the weekends. And I thought, yeah, let's do that. And I carved out, a couple of weekends for our trade shows. And during our IPO period, I worked every single day except one Sunday. But that was always my model. So now, with my kids a little older, I say, I'm happy to be available to you. But if it needs to be right away and it's Friday, I need you to come to me. So they'll come to the house in the evening, or they'll come to the house on the weekend, or sometimes we'll meet at the airport if I'm flying in or they're flying out or whatever. I'm pretty flexible on finding time for my entrepreneurs, however it works. Time is definitely not my friend. It's just anyway, at one of these sessions, we were talking for, it was like an hour in, and the entrepreneur had all these questions. And I looked at him at the end and I said, you're not really asking me about your business. You're questing for the meaning of life. And it reminded me of me in my youth. And I traveled around the world. I literally bought round the world tickets. I was just trying to find the answer. And my view is the meaning of life is different for everybody in some ways, but you won't find it, it will find you. And this whole long ramble comes down to this. For me, when I finally found my meaning of life, it's that happiness is not about having what you want. It's about wanting what you have. And when you have satisfaction in what you've achieved at whatever level that is, that's happiness, right? The problem, and in fairness, sort of going back to my push on where things needed to go for people to be a venture scale entrepreneur, is when your desire can never be quenched because it so far outreaches, like when it's never good enough. That creates an enormous amount of unhappiness. And so, I think it is human nature to always want more. It's the natural sort of greed is good thing from the Wall Street movie of greed for life, greed for success, greed for, and ultimately when what you're building makes you happy because it is at the right sort of I don't know, equilibrium, then that's awesome. And that can be true at any level, right? Now there's this whole movement amongst younger people, the FIRE thing, of being fiscally responsible and retiring early. I'll tell you, by the way, I retired early and it wasn't something I need to do again. It wasn't something I enjoyed. It's quite boring. But, like fiscal responsibility so that you can have flexibility is a great thing. I mean, having flexibility, and look, bluntly, I think I mentioned I had a Dove Bar truck, right, in college, and I would drive around and sell my Dove Bars, and I had fiscal freedom because of it. Because on a weekend, I might sell a couple $1,000s worth of ice cream bars, and have $1,000 in my pocket as a college student. Hey, in a weekend, that was great. That was a lot of freedom. I was very happy with that. I didn't need to
So
take
one of the things that we have tried to do in 1 Million by 1 Million is pose that question of what is success, and exactly your point. We have come to the same conclusion that success is personal. You have to define your success. At what level do you feel whole and you feel like you're good? You're at peace with yourself, and define that and execute to that instead of trying to live somebody else's life. Yes, there's a category of people who want to build these billion-dollar businesses, but there are trade-offs in that. And if that's the direction you want to go, great, but know what is involved in that. Don't stumble into that. That's a path. That's,